Hi, good afternoon. You're watching Closing Trades right here on 18 Hour with me, Aisha Faridi, Nikunj Dalmi in the studios. Not really turning out to be the best of afternoons. What looked like it's going to be one of those 1% kind of down days. We're finally getting a little more sold into. And right now we're staring in at the lowest point in the day. We're down about over 500 points for the Nifty alone, and that's a vicious over 2% cut. Still holding on to that 25,000 key level. Having said that, it's important to note what the global markets as well have done. For us, of course, the selling began on Monday itself when you had that huge grinding halt coming in for the markets. Consolidated a little bit on Tuesday, Wednesday, of course, being a trading off. And once again, you are seeing the selling only getting a little bit exaggerated. In fact, it's a lot more when it comes to the mid-cap end of the market as well. By the way, Europe is no different too. It's over 130 point knock coming in for the DAX. The CAC as well is lower by a good 1%, and the FTSE MIB is falling about 250 points as we speak. What about the US futures? When we came into trade, remember, they were pretty quietish overnight, but now, of course, there too, the selling has picked up. It's over 150 point knockoff for the Dow futures, the S&P futures as well in the red, and the Nasdaq futures as well trailing by a good 0.5% as we speak right now. And of course, a lot of heavyweight led selling, Nikunj, like we were just talking about before the show. It's clearly smacking off some ETF selling.
I think there's only 2 or 3 stocks which are actually trading in the F&O market with a green buy. That just tells you how intense the selling is and which way things are moving. I won't get into reasons why markets are selling off. Markets always go up and down, reasons they follow. This market was overdue for a correction. Now, where do we go from here? That is important. Frankly, if it was a scary situation, then trust me, Europe would have fallen flat and European futures would have gone all over the place and Asia would have had a mixed start. So Asia, Hong Kong actually is down. Rest of the markets have closed in the green. Crude is behaving itself, and US futures are not pointing to any kind of a scary, selling. So what's happening in China? Well, money is moving from one market to another market. That does not make equity as an asset class weak at a global level. Crude seems to be behaving itself. Everybody is of the view that this playbook, which has been played out over the last couple of days in Middle East, the situation is unlikely to simmer anything longer. It may just end up becoming like a pinprick. And the third factor is this entire F&O. Volumes, of course, will get impacted, but I think there is nothing new about what the new changes by the F&O market are coming. This market had become Humpty Dumpty. It was due for a fall. We've been talking about it, that the weight of the market itself had become so obese that little bit of weight shedding in this case was overdue. So where do we go from here? Time to buy? Too early to buy? Time to still sit on cash, or maybe it's time to create some adventurous shots. Let's discuss all that with Sandeep Sabharwal, Kunal, and then Nuresh. All right, Sandeep, I'll start with you first. Markets were due for a fall. The selling has come. Could this accelerate further? Could this intensify further? Is it time to put money to work now?
I think it's too early to put money to work because of the fact that, one, there could be global factors at play, and globally markets could correct, and that could lead to some sort of fall coming in India also. Second, if you look at economic data which has been coming out, started right from the core industrial data information, where core output was actually down last month. Like some impact was there of heavy rains, etc., but still it was down. Then we've seen the pre-releases by many consumer companies, which don't seem to be very encouraging. So clearly, I think high food inflation, as well as slow growth in disposable income, lack of any fiscal incentives, etc., high taxation has started to have some impact on economic growth. Now, hopefully, the festival season sentiments, etc., will be positive, and we will see some revival coming through, and the RBI might also change its stance. So I think those things could happen and stabilize the economy. But right now, not only was the market heavy, but the economic data also is somewhat concerning in the near term. So I'm hopeful that the festival season will see good data points, but we need to watch out for that.
Where are we headed? Is this beginning of a long-term, a meaningful change of trend, or in hindsight, when we would discuss this lean patch, it would be a great buying opportunity?
I
Nuresh?
don't think.
Yeah.
Sandeep can
So
hear me,
if you,
Nuresh cannot hear me. See, Sandeep is prompting Nuresh now.
yeah. So
Nuresh,
if we look at it,
can you hear me?
see, yeah, I can hear you. So the current correction is more driven by the fact that Chinese markets have gone up 20-30% really quick. And this has happened after a really long time, the China-India performance shift. Now, this has led to a lot of selling happening on the heavyweights. So for the first two sessions, the mid caps and the small caps did not get hit much. But today is the day where the breath has also taken a hit. And that tells you that this flow could continue. The shift could be for some more sessions or for a month. It is difficult to say when it stops. So after the initial bounce back, today's recovery could not sustain. That indicates the selling pressure is still pretty high. So in this case, one would be better off waiting out and wait for a recovery and on the way up buy. So maybe buying 200 points after a recovery with a stop loss of 200 points would make a lot more sense now. So out here, selling, if it continues, we do not know where it stops. So this could be a good opportunity to slowly accumulate as an investor. And a lot of stocks in the heavyweights are taking a knock. So you have Reliance Industries today back to the prices where it was on June 4th, 5th. So there could be certain opportunities which would keep coming across the board. So it could be more stock specific given the outflows. You may get some stock specific opportunities going forward. So looking out for something like Reliance closer to 2750 to 2800 is a good entry price for the long term.
Right, okay. Kunal, what is your own sense? I mean, it's pretty much across the board of a selling, barring a few odd metal and other stocks like a Petronet, LNG, granules here and there. You think it's going to abate here, or is the selling going to worsen in the coming days?
See, I think there are a lot many data points to look at. Last 5-6 months, we've already seen 5% kind of corrections almost 4 or 5 times. For the indices, it started off from the month of I think March or April when the mid cap correction first started off. Then the election results, then during the budget as well as the August sell-off. So I think in that context, we've seen 5% corrections quite a few times. Now the only change which we are seeing this time around is that the Nifties and the Bank Nifty, both of the indices, are coming very close to their respective 50-day moving averages. So in the previous instances of the indices going through a correction, we've managed to just about make a bottom closer to their 50-day moving averages respectively. So on a technical basis, we could be looking at the index forming a very similar kind of a base, say in the next couple of days, and assuming if we hold on to that 50-day moving average. But I think for that, we may have to wait out for one more or maybe a couple of trading sessions. The good part about the market so far in terms of the data point is that the put call ratio is at 0.55, 0.6, and generally we've seen the index forming a major bottom when the put call ratio falls below the 0.5 mark. So net, my sense is that in case if in the next 2 days, if we see maybe another 250-300 points correction for the index, and if the data points start to become oversold, I think that could be a better point to try and go for a contrarian buy.
Sandeep, what pops up on your radar now? Assuming that we could be in for a 5 to 10% correction on the index, 3-4 has already happened, another 3-4-5 could come in. Mid caps will fall 10, 15, 20%. What pops up on your radar which you say, I will start buying on a 5% fall, add more at 10%, and I'll buy my complete quantity if it falls 15%?
Normally, I don't do such staggered things. So the view was that there could be a 5 to 10% correction. So we'll wait till possibly, let's say, hopefully it goes towards more near 10% from the top kind of correction. And at that level, there could be opportunities. So I think the first level of buying could be looked at on the large cap side. So I think, for example, Nuresh was talking about Reliance. So I would agree that if Reliance falls in the 5-7% from current levels, that could be a decent stock to buy for a 15-20% kind of upside over a year's time. Then some of the banks, like if the markets correct, typically banks have a higher beta. If they correct more than 10% from current level, then we could have an opportunity to look at those. L&T, if it falls near maybe 3,200, 3,300, then we could have a look at it. On the large cap side, I think these could be the opportunities.
Leg of decline, we've seen PSUs again getting completely clobbered. PFC, REC, HAL, BL, and these stocks were already weak. They were down 15, 20, 25% and they're falling further. So can we decisively say that the party in PSUs is over and we are in for a bit of a dry patch there.
So in terms of PSUs, it's been very clear that say the ones which had rallied a lot, defense, railways, have taken a pause. Power may not be very similar. So if you look at NTPC Power Grid, they've been decent. They've not seen a large correction as such. So one thing is clear, the sectors which rallied very well from the PSU basket could continue to face selling pressure. So even when there is a bounce back, it may not sustain. So for example, if you look at a Cochin shipyard, which is down, one day it popped up 10%, we are back to the new lows. So out here, one is better off, say, avoiding the overrun spaces. Look at spaces which have been consolidating a lot where there could be an opportunity. So something like oil and gas is interesting. So even today, oil and gas looks the most promising sector. It could be the whole basket, whether it is ONGC, OMCs, or a Mahanagar Gas or an IGL. So I would say in the PSU basket, oil and gas looks the most interesting space with a medium-term outlook.
Oil and gas it is within PSUs. We'll take a very quick break. The markets are extending their decline even further. Almost a 1800-point knockoff on the Sensex, 550 points lower on the Nifty, and the breath as well at the bleakest point. Continue tracking markets on the other side.
All right, now what do we have? We have a 2% cut on the market. We have a market which is reeling under pressure. I like to bring one data point here, which is that Hong Kong has closed down and China is shut. So if you're thinking China's up 8%, that's 30th September's data. They will open on Monday and then we'll see what happens there. So I don't know how much of this India selling is compulsive and how much is, largely because of China. Look, markets were heavy. They were extended. They were due for a fall. And, October is going to be different from September. September was about Fed. September was about drop in crude. October will be about what will happen to earning season, how the festival season demand would move, and what we are likely to hear from RBI. Those are more important factors which I think should be considered. Sandeep, let's assume that this China adjustment gets over in a couple of days. Then what comes back? Will it be rate sensitives? Will it be consumers? Will it be global facing sectors? What will come back the fastest?
I think rate sensitive can come back faster if there's a stance in the Monetary Policy Committee meeting, because I think the MPC is clearly falling behind the curve in terms of recognizing that the economy is actually slowing down because of tight liquidity. Like they've eased out liquidity a bit, but rates are still too high. And so I think that's one part of it. So that's where we'll have to look at. And secondly, we'll also need to track how the entire. So I think this festival season becomes very important because after 2 poor years of consumer demand, a lot of expectations are there that we will start seeing a revival now, and a lot of the marriage dates are also pushed back to the second half of this year. So I think those are the trends we need to watch out for. But the near-term economic data is concerning, especially in the light of the valuation at which markets are trading. So we need to see whether we go into an extended period of non-performance of the markets or the markets can bounce back.
Yes Bank is at 21. Where is Vodafone? Vodafone is at 9 rupees, 9.5 rupees. And Suzlon is locked down. So Kunal, this is the typical patronized retail club, right? Yes Bank, Vodafone and Suzlon. We've been talking about it, that how they would be the first ones to fall when markets have to fall. Vodafone is down 50% from its high. Yes Bank was 20, 30, or how much was the high?
Yeah, I think Yes Bank was around 30, 32.
30 has become 22. And Suzlon was how much?
Suzlon, the recent high for the stock was around 85, 86.
85 has become 76. But Vodafone is where the crack has been the highest.
Yes.
Where are these three trading patronized stocks headed?
It still looks very weak on the charts. So, what happened, Nikunj, was Vodafone Idea as well as Yes Bank, both of these stocks almost a month back, these stocks had broken below their long-term averages. And that was a very critical juncture for these stocks, because when stocks fall sharply below their longer-term averages after staying above those levels for months and quarters, that generally calls in for a reversal. And when that happens on the back of higher volumes, traders have to get a lot more cautious. And I think from those 11.5, 12.5 mark, for example, for Vodafone Idea, the stock has corrected another 20%, come down to 9.5 where it's trading right now. And even for Yes Bank, I think the 200 EMA has been broken much ago. So I think in that context, both of these stocks, they continue to look weak. Now there comes a point where these stocks become oversold on the charts. As of now, there is no data point which still suggests that these stocks are oversold, which means that these stocks may keep on falling, over the near to medium term, and they may be not the first ones to try and get back into a recovery, but they may be the last ones, as and when the mid caps and the small caps, they start to recover. The concern over here, or the third stock, which is Suzlon, that stock is now trying to break below its 50-day moving average. It's still way above its long-term moving averages, which means that the stock has a lot of cushion for itself. But nevertheless, with the sudden weakness in the mid caps and the small cap stocks, we could probably expect maybe another 5 to 10% correction for Suzlon.
Okay, that's that and some of these fancy trading names. But Sandeep, you think tactically at least it's the large caps which will win whenever the market does recover? Or would you say be stock specific and story specific? There is no harm in looking at mid and small caps either.
Yeah, there's no harm. I think this is a myth that one segment will not perform. It's a very stock specific market these days, and given the kind of liquidity which exists with the huge number of PMS, AIF players, etc. nowadays, so there is always interest in strongly performing mid-tier companies. I think we have to look at opportunities all across. At some points of time, uh, large caps could offer more risk reward, and then so it's better to allocate to large caps at other times, and especially if there's some risk on the economy and economic growth. But if the monetary policy cycle clearly starts moving down, and typically in those periods, mid and small caps do tend to do well historically.
That's a possibility in the upcoming policy on October 9th, or will it be a little bit of a lag before we see rates easing?
So I think if they don't act now and if they keep the same stance, then we risk the markets actually selling off deeper than what the base case is. So let's hope that they do recognize like now new external numbers are coming in. I don't know how much time they have to absorb whatever discussions happened earlier and now. So it's important for the monetary policy committee to realize that the things are not as hunky-dory as what they believe it is.
15834. That's the bank nifty for you. It has actually not been the collateral damage has not happened there. Couple of stocks which are worth revisiting. One is ITD cementation up 18%. Look at the volumes there. Somebody knows something is happening there. I don't know what. 20% higher in a market where otherwise stocks are just going here and there. The other odd one out is Angel Stockbroking. They were supposed to lose because of F&O volumes. Markets are saying, no, we knew this was coming. Sometimes you buy the rumor and you sell the news. In this case, everybody has sold the rumor and they're buying the news. And the other one is BSC. Today, BSC has traded volumes which are actually just a notch lower than Reliance. That makes it BSC the second most traded stock on National Stock Exchange. Angel Broking, again, right up there in terms of the total volume it has taken. Sandeep, the story is F&O volumes because of these new SEBI regulations should come down. Markets are saying that we bought that rumor, now we are buying the news. We sold that rumor, we are buying the news. Ulta ho gaya.
Because the reality of all of it is that, if uh, unless and until some restrictions actually come in a way where option trading becomes more difficult, we could see that continue. The only good thing which came out is that the weekly expiries will only be one per exchange. So that improves the speculative activity a bit. So I think these things will be washed on terms of volumes, whatever the way they track the losses, etc. And well, right now, nothing has been done on the stock futures side. So we need to see whether something will come there also.
You have enough exposure to mid and small caps as well. You flagged off that if the decline were to continue, Sandeep, you will be, looking to buy even a Reliance and L&T. What within mid and small caps is looking interesting to you to buy on dips?
I think among the stocks which I track, so companies which are doing well include companies like maybe on the infra side, Ahluwalia Contracts, which has fallen around 25%. So I think it's now actually in a range where I would like to be buying, but since the near-term view on the market itself is negative, so I would wait it out. Or something like And NCC, which has given up 15% from the top, maybe if it gives up another 10-15%, it could come into decent buy zone. UPL as a contrarian play, it's decent to me because I think things are turning around in the global agrochemical cycle. So there, but I would like to watch out for this quarter results also to form up the view.
All right, Sandeep. Thank you for sharing those ideas. We'll flash them as well in terms of stocks which are on Sandeep's radar. Ahluwalia, NCC, UPL. These are three stocks right, Sandeep? Ahluwalia, NCC, UPL, everything on decline, right? Have I missed anything?
Yes.
Okay. There was a fourth one also. Did I miss it or you didn't say it?
No, I didn't say it. You.
Okay. I'm assuming that there's a
I
fourth
think
one.
you just
Taking my chances if there is anything left. All right. Now, LIC is not taking chances when it comes to moving into the healthcare business. Now, they've gone on record with their numbers and they've stated that, look, we are interested in buying or interested in foraying in healthcare. LIC is not in healthcare, and many may not realize that LIC only sells life insurance. Now, LIC is looking at buying less than 50% stake in a healthcare insurance firm. Which ones would it be controlling? Would it be non-controlling? For all that and much more, let's go to my colleague Anurag Shah.
So in August, after quarterly result, LIC has said that they are looking to acquire a standalone health insurance company and they are actively working on it. But what we are picking up from LIC sources that LIC will not buy more than 50%. LIC is looking to buy less than 50% stake in a standalone health insurance company, and their actuarial team is working on it, and LIC intend to close the deal in this financial year only. So as per our sources, LIC wish to have not a controlling stake but a say in the board where they can influence the decision, but not the controlling state in the new company they are willing to buy. Another development which is happening in the insurance space is the composite license, where government is planning to bring an Insurance Act amendment. So as per our LIC sources, that LIC will not apply for the composite license also, and to venture into the health insurance space, they don't need separate license also, and they are willing to buy a stake in a presently available health insurance company. So presently there are 7 standalone health insurance companies. Out of 7, 2 insurance companies started in the year 2024 only. The Narayana Health and the Galaxy Health Insurance Company got the license in 2024. So LIC will buy less than 50% stake in these from these 7 insurance companies, and their actuarial team is working very fast, and they intend to complete the deal in this financial year only. As the health insurance space is the rapidly growing space, is the biggest segment in the non-life insurance sector. Around the 40% of the overall business in the non-life insurance space comes from the health insurance space, and LIC want to invest in a standalone health insurance company to buy a stake less than 50%.
All right, Anurag, thank you very much. Before we take a break, I just want to mark a trend here, and these are not the stocks which should do well when markets are so weak. JP Power, 5% higher. Ratan India Power, 5% higher. Reliance Power, 5% higher. Hello?
Call it the tail wagging the dog.
But the dog has to run. The dog itself is right now, slowing down. Why the tail wagging?
No, and this is not the first day where we're seeing the stocks. And in fact, I've
when on a day when everything is down, the weakest stocks which you normally associate with trade and perhaps speculation, they are the ones which are going up on a day like this. The dog has stopped walking and the tail is still wagging.
This is the prime example of pure speculative behavior, speculative intent of the markets. And I think that's where the last 3-5 days, we've seen these stocks hitting upper circuits. I think Reliance Power, of course, over the last, 10 odd days, the stock has consistently, hit upper circuit from 30-35 to 50 plus levels where the stock is trading right now. So I'm not sure, I don't track these stocks on a regular basis, but just looking at the trend over the last 3 days, it seems like more of a speculative intent.
All right, let's take a break. Half an hour of market left. No recovery inside whatsoever. Europe is down but not out, but it is Reliance which is really acting like a sledgehammer in the market today, which is really puncturing the nifty momentum. Down 4% now. Kunal, maybe you want to look at when was Reliance down 4% last. I think must be the budget day or something. But today it's down 4%, and that's a nasty fall for Reliance. Well,
Closing trades right here in 80 now. About a 2% fall is what we're seeing. So still down 500 points for the Nifty. The Sensex is no better picture. It's an 1800 point knockoff for the Sensex as well. Some of those active losers, it's the OMCs actually. You are seeing that knee-jerk reaction to the crude spike up of about 4%, which has transpired in just the last two or trading sessions. So BP, both those stocks down. In fact, HPCL is down a good 7% right now. BPCL down 5.5%. GMR Infrastructure is down 5.5%. Dabur, of course, after the Q2 updates, has taken quite a bit of slamming from the word go, gap down, and hasn't managed to resurrect from there. So another 7% fall there. And names like PFC are also seeing some severe profit taking. 6% lower for PFC as we speak right now. And yeah, Nikunj, Reliance is now down 4% on the futures.
it's below the 200 DMA. This must be like, just imagine, Nifty at an all-time high. Stock which has the highest benchmark weightage is now below the 200 DMA. Kunal?
Yeah.
It just doesn't add up, right?
No, it's the second
Either
highest.
Nifty has to come second highest. Oh, HDFC Bank now after merger is the
8.76
highest.
I think percent is the weightage
Yeah,
for
because
Reliance.
after the merger, it's the
Yes,
other.
and
Okay,
it's
second
still
highest.
Second highest weightage. But still, I think it's meaningful enough. And the stock has fallen from 3200 to now 2800 mark. And it looks very fragile in the sense that the stock has broken below this 200 DMA. Because, we've seen this time and again for many of the stocks that when these stocks have for months managed to hold on to their long-term averages and broken below those levels, it's actually a series of a start of a fresh downtrend for these stocks. Now, of course, the charts for Reliance Industries are not indicative of a major correction, but even a 5% correction for the stock over the near term, I think should have a major dent on the benchmark indices also.
Let's say second highest weightage, 8-9%. That has gone to the 200 DMA. 200 DMA, they say, is this line in the sand. It's a real indicator of a long-term trend. So does that mean that if a heavyweight has gone towards 200 DMA, HDFC Bank has not been a pronounced outperformer, the 20% weightage now gets jammed. And if that gets jammed, Nifty free flowing is going to get jammed also.
In fact, I did this study long time back that, so what's happened today is, Nikunj, almost 15% of the index weightage. Reliance, L&T, the IndusInd Bank, and there's one more stock. These are the four stocks which are trading below the Tata Motors. I think these are the four stocks which are trading below their 200 moving averages.
Tata Motors is below 200 DMA?
Yeah, below 200 DMA at 950.30 where it's trading right now.
I'm realizing that.
So,
This
historically...
was the higher flyer of last year.
Yeah, from
But
1100.
it's had a lean patch now in any case. Yeah.
The
So
last
you
2
were
months.
saying?
So, and Nifty is almost 10% higher than the 200 moving averages. Now, typically what happens is when the percentage drops down to 25 or 30% of the weightage of the index, when 25% of the index weightage falls below the 200 moving average, that's where the correction for the index falls or intensifies. So right now we are into that soft zone where the index is only 15% of the index is below the 200 DMA. But if there are more stocks which fall below the long-term moving averages, the pace of correction could intensify.
Okay. So you're saying this is not it. It could get even worse from
Yeah,
here.
because you're
But do
looking-
you see that coming, Kanan? Looking at how the charts of these four index heavyweights is.
See, in the last 4 days, Bank Nifty has created 2,500 points, and it took almost 10 days for the Bank Nifty to rise 2,500 points. So the move on the downside, whenever it's quick, and if it's followed by a lot of multiple reasons, and you can't attribute towards just one of the reasons why the markets are falling, which means the selling is not yet over.
Yeah, it's a 2,200 point fall on the Nifty Bank. I think this is almost turning out like one of those contra-indicators. Whenever the Nifty Bank moves, the market turns around. Yeah,
See,
pretty
where-
short-lived the move always.
See, where the market positioning has changed is that after Fed, everyone thought that FIs are back and they were here to stay. And the general view was that Fed will cut rates, money will come to emerging markets. So would have thought that even though we got that 1 or 2 big days of 8,000-9,000 crore, that actually will not be, that was just a flash in the pan, because flows did come, but flows have moved to China. Now, will they come back from China to India? Will they rotate back into, or this rotation rally will continue? Very difficult for that to fathom. My limited point is that while we may center a lot of view around FIs selling, FIs have been net sellers entire 2023. And this market has been really leaning on a lot of domestic flows. So the story of this market was always domestic flows, and that I don't see changing. Mutual fund cash levels are high, NFOs are still on. So at lower level, if the earnings season is not all that flop show, or something scary does not come, or if, what looks like a pinprick right now in Middle East, if that does not get into a big body blow, then I think markets will stabilize. It's a matter of a week or 10 days. But I don't think there is anything scary so far in terms of looking at the trends. Mayuresh, what do you think? I mean, it's getting bad. Could it get ugly? Could this bitter get ugly?
Afternoon, Nikunj. No, I think two, three angles. One, obviously, in terms of how global macros are shaping up. The expectations in terms of the China stimulus, as you put in, has clearly buoyed sentiments in terms of foreign flows towards China. Again, undervalued, underowned. And therefore, the kind of move that we saw in the Chinese markets because of the stimulus was something to be watched out for. The second element, obviously, is the US data points as well, from a macro standpoint. Have been relatively stable so far. So all indicators are probably indicating that data point should be reasonably stable enough going forward. Even in the earnings context, our US team feels that earnings might be a little bit soft as far as Q2 and Q3 numbers are concerned. But Q1 of the next financial or calendar year will also probably start indicating better earnings coming in for a large part of US Inc. The Japanese change of leadership created some jitters as well, Nikunj. But again, I think the statements thereof that he's going to take it very, very easy as far as monetary policy is concerned has again probably just soothed some sentiments. Obviously, I think the 2 points that you put across, if this escalates in terms of the Middle East conflict, the large unknown is to what extent can this happen. I think that's where the markets are probably fearing at this juncture. And even in our own context, as far as earnings are concerned, earnings might be a tad bit soft going into this quarter's numbers as well. But with good monsoons, expectations of rural recovery, second half should be relatively better as far as India Inc. is concerned. So again, not looking at a structural downside, liquidity remains strong, and therefore any fall in the market that probably comes through, liquidity might come back and cushion them.
HDFC Bank 2.5% lower, Adani Enterprises 2% lower. Mayuresh, let's take that point slightly further, which we were discussing with Kunal, that we've got a big heavyweight which is down. That's Reliance 4%. Should we take it casually, or this could have serious ramifications? Nuresh.
So we are back to the same prices. If you look at it, say on June 4th, we made a bottom around 2,700 to 2,750, close around 2,800 on Reliance Industries. So we are going back to June 4th, which is an equivalent of sub 24,000 Nifty. So that tells you one part of the index is actually getting into zone where it becomes an interesting buy. And so eventually we may not go back to similar 200-day moving average for the Nifty, but stocks may go there and create an opportunity. And it's a flow-based move, and we've seen that it gets adjusted really fast. And we'll have the Chinese markets open also next week. So this could continue for 2-3 more sessions. But overall, would be looking out for opportunities in something like a Reliance rather than getting scared of it.
Mayuresh, how would you map today's selling in Reliance in isolation? I mean, I'm not obsessed with Reliance or something, just that it is happening that I've said Reliance 20 times in 20 minutes.
Two aspects to this, Nikunj. I think one, in terms of their core oil and gas business, Singapore GRMs have been extremely, extremely weak for the quarter gone by. And therefore, the upstream business that Reliance probably carries, there will be some elements of softness reported in those numbers. Again, in terms of their petchem business as well, the downstream product business where the spreads specifically for the end selling prices seems to be soft as well. Petchem might also be a little bit soft. To their support, I think the retail businesses might just stand up, both in terms of how Reliance Retail is expected to perform, as well as Jio, in terms of both the subscriber addition that we've probably seen and the expectations in terms of stable numbers from them as well. So I think the retail businesses should hold up, but the upstream and the petchem business should probably be soft, which balances out the expected earnings trajectory for Reliance, at least for this quarter and the next quarter as well. So I think the markets are going into Reliance's earnings, expecting that they will be soft this time.
Just looking at some of the other, key laggards as well in trade. There's of course BPCL, there's Axis, there's Shriram, which is down about 4.5%. Tata Motors has slid a good 4% as well. Even L&T now lower by about 4%. Maruti, there's of course Reliance, which we've been flagging off, Bajaj Finance, there's Wipro, Adani Ports, Kotak Bank, HDFC Bank. All of it is seeing some pressure points. Even metals, Kunal, right? They've come off from their day's highs. I mean, yes, they're in the green, JSW, Jindal, Tata Steel, but definitely off from the day's peak.
Yeah, so you might see some bit of profit booking over here, but I think till the time you see stocks like JSW Steel, Jindal Steel, Dalco to a larger extent, when these stocks hold on to the breakouts, show a price performance of a positive 3%, 4% on an average on such kind of market days, I think that's generally indicative that the trend is here to sustain as well as build. And I think I've been maintaining this stance over the last 1 month that the only two stocks which are strong enough from the entire pack is JSW and Jindal Steel. And the third one, which is coming back into a breakout mode after almost, I think, 8-9 months of consolidation, is Vedanta. I think these are the three names which I would want to concentrate on from the metal pack. So my expectation is that the rally and the trend is here to sustain as well as build. And I think one should be focusing on top three names in the metal pack.
I'll give you another example as to how markets are just not differentiating between right and wrong. Now, if China does well, metals are doing well, logic. If China does well, then Tata Motors should also do well, because JLR gets a lion amount of business from JLR, but that is falling because of global factors. That is falling because of Middle East. Metals are going up because of China. So it's a strange market where you're finding a variety of reasons to ascribe to where things are. But is the bull run in autos getting over? Mayuresh, this is one big surprise pack for me. For the entire month of September, we kept on flagging off that boss discounts have started. Car companies are no longer enjoying pricing power. Now the Dussehra sales also are pretty much endorsing the same. Why are auto stocks still holding on? They've hardly corrected, despite the fact that discounts have started and the margins would be down in the Dussehra and Diwali season.
So to that extent, Nikunj, I think the expectations that the last 2 years have been extremely strong for most auto companies, whether it's two-wheelers, four-wheelers, truck makers have been laggards of sorts, but at least for two-wheelers and four-wheelers, the last 2 years have been exceptional. Obviously, I think with the base that they're probably carrying and the expectations of whatever launches have taken place in the past few quarters have really worked well for auto companies. But I think they are going through a phase of consolidation at this juncture. A large element on the expectations of earnings upside, specifically for both two-wheelers and four-wheelers over the next couple of years, lays on the base fact that more launches expected over the next few quarters. Electric launches specifically, two-wheelers, four-wheelers, the platforms that they're coming out with are expected to keep their new launch sales quite buoyant. Along with that, the expectation largely that is getting penciled in as well is that pricing might again, which was probably a constraint for some fence sitters, as the rate cut scenario starts coming in place, at least for the higher price or the premium price cars, it will be a little bit more affordable with rate cuts coming through to probably own a premium vehicle as far as four-wheelers are concerned, and even the higher premium range of two-wheelers as well. So I think second half is where I think some element of earning stability should come in. And next year, I think the markets are banking on the fact that with new launches, numbers should normalize and start improving as far as earnings are concerned. Valuations through the roof, Nikunj, absolutely, for both two-wheelers as well as four-wheelers. And therefore, I think one should be a little bit more circumspect and careful in choosing what you're picking within this space.
This is where things are stacked up in terms of the mid. It is not very, very bad. Let me put it this way. Two more stocks, Naresh, which have been the poster boys of this bull market, and they've retreated very, very sharply. REC and PFC. In REC and PFC, Naresh, is this a good time to buy the decline, or again these are trends which have changed in favor of trends which have changed for a long period of time?
Looking at the way the whole power pack has been holding on, doesn't look like PFC REC could go into a sharp correction. So if you look at smaller power companies are also doing well, being the lenders to the sector, and technically they've gone. Both these names have been in a consolidation as well. So for example, if you look at PFC, the stock was at the same prices of 480, 500 in February of this year. So it's been a no return period for last 6-8 months. Same is the case with an REC. So given that the consolidation is still in play, would like to buy it on the lower end of the range. So something like 450 odd levels for REC and something like 420, 440 levels for PFC. That could be an entry point. Or one could go staggered going forward. But as of now, at current levels, would wait out and say wait for some more correction, but not looking at it as a stock which would top out soon.
2%, it is not a very scary fall. You want to mark Europe? whatever is available. You definitely want to bring out Asia, because in Asia, Hong Kong is down, China is closed. That's also worth revisiting. And metals are holding on.
Europe is down quite a fair bit actually. We're down over 100 points for DAX. The CAC is also down about 1% or so. 192 points gone for the FTSE MIB and the Stock 600 as well. Of course, our markets, I think, would be the region underperformers. But yeah, and Hong Kong also down about almost 1.5% there. But yeah, Europe and even US futures, they too are seeing weakness. And that's the thing, right, Nikunj? What we're seeing right now is pretty much a global move, and I don't think there would be clarity until the world markets stall and then you see a recovery coming in. Right now, we're still pretty much getting swept away.
Yeah, Aisha, money moving into China means that markets are rotating from an expensive market to an underperforming market. If it was like a global tsunami against equities, then all markets would have fallen down and China would have fallen the first. So the fact that, sectoral rotation has started, it is country rotation which has started, but money is moving into risk. All of us thought that India, being the pedestal positioning it is enjoying, it will get lion's share of inflows because Fed will cut rates, money will move to emerging markets, India would get the optical benefit of that. That has gone to China. Has it got permanently to China? Very difficult to say. But the kind of falls what we've seen, now think from an institutional standpoint, yes, suddenly markets will start looking attractive. Imagine Reliance at 200 DMA. Imagine banks have not gone anywhere. PSU stocks have corrected enough. Autos, Tata Motor, what was the high? 1,000?
1100.
1100 has become how much?
930.
I'm just putting some context here that a lot of these stocks have already started correcting. So it's not that everything in the market is euphoric. Yeah, you got pockets in SME, you got pockets in IPO, you got a lot of stuff which is expensive. But when you see this kind of a nasty correction, you actually would have to take a step back and say, okay, I'll wait and I'll see where I'm getting value in this market. At some point in time, Idea Vodafone will also start looking attractive because the debt has become, it's fallen so much. So when you see a correction like this, I think these are times when you would say that, okay, thank God this correction has happened, otherwise this market would have got bloated. So these markets are not seeing what could be called as if risk-off moment where everything gets plastered. If it was a mandate to sell equities, then China would have fallen flat by now because that's the weakest market.
But China is not trading right now.
No, I'm just saying, I'm saying that if this was a mandate for risk off. Second, crude is behaving itself. So it may just end up being a pinprick. We had similar situation same time last year. We didn't talk about it, but markets have lived through it. So if this ends up becoming a pinprick from Middle East, then crude will settle at 73, 74, which is where it was always settled. We got that brief moment of 4-5 follow drop. So it settles there. Early indications of festival season are not bad. Hotel booking, DLF we spoke to. So it's not looking that bad at all. And then on top of that, mutual funds are sitting on cash. NFOs are on. And domestic liquidity is strong. So to make a case that, okay, we peaked out for the year, I think it will be too early. It may happen, I don't know. But I'm saying that based on what we have today, I think in a day or two, this storm may just settle down.
Yeah, and even if it happens, I mean, even if we've seen the best levels for this year so far, it's not really that bad because remember, you've got two very large IPOs as well, which are still to come before the year closes in, both Hyundai as well as Swiggy.
Yeah, so I think I saw the market last Friday and last Thursday, and it was up 20% for the year. 20% for the year.
It's fabulous returns.
It is fabulous returns.
Yeah.
I mean, this fabulous return at the beginning of the year, we had projected that the market will give you no returns. From no returns, which was the general strategy call by every brokerage who gave you a target of 18,500 to 21,000. Right? That was, we started the year at those levels. Right? Just correct me if I'm wrong.
Yeah, so I think for the Nifty we started closer to 21,000.
18,000 to 21,000 was the range.
Yeah,
Everyone
correct.
said that between 18.5 to 21 this market would move for the entire year. Where are we standing? We are standing 4,000 point above what the consensus number was. So we should be mighty happy and delighted that this market has been far more rewarding than we thought. And individual stocks, Aisha, they've just hit out of the park. I
was just going to come to that. That 20% is just the index. What about those individual stocks?
It's been a very good year. It's been a very good year, and we are not done with the year. Yeah. You never know that October, November, December, the last hurrah in the market could still be left. Yeah. I mean, why are we saying it's peak for the year?
Yeah, no, I'm just saying that even if it is, it's really not
exactly,
bad.
Exactly.
Worst case scenario, if we saw the best last week, it's
Absolutely.
Still not bad.
You don't want to end the market on like a euphoric high. Yeah. Then 2025 becomes a terrible year to reckon with. You want some fear in the market because, what I've learned over the years is that markets are like a cardiogram beat, always goes up and down. What you don't want is a flat line. So you don't want that's dead actually. Mayuresh Joshi, come in on this engaging conversation with your headphone on.
I've taken it off. There are a lot
Okay,
of
that's why I
planes going
prompted
over
you.
my
That's why I prompted you.
head. A lot of planes going over my head. No, so yeah, I think ifs and buts for the market. But again, I think the consensus call here is that corporate earnings should improve in the second half. Mutual funds, a lot of domestic institutions are there on the sidelines. The IPOs that Ayesha was talking about, I think there is plenty of appetite in the market in terms of liquidity. And therefore, I think if liquidity gets sucked off because of these IPOs, does not seem to be this case with the Indian ecosystem at the moment. And China, I think, are there genuine signs of recovery? I think we just had a call at the beginning of this week with our Chinese team as well. And they are hopeful, but they are not 100% convinced that internal data points are suggesting to a genuine growth kind of a dynamic playing out in China. So a lot of factors are pointing that if correction does come through, I think quality stocks will again be looked at and should be looked at by long-term investors.
Okay, before we close in for the day, let me just take in some BTST ideas as well. Or Naresh, is it going to be STBT?
So a mix of both a sell and a buy. First would be a sell on Cummins India. The stock has made a lot of tops around 3,900 and breaking down now. Stop loss at 3,750, target price of 3,550. A defensive buy on Dr. Reddy's, which is holding on, stop loss at 6,700, target price of 6,900.
Okay, Kunal, what's on your list?
I'll go with a couple of buys, two buys over here. So the first is about TCS. After quite some time, the stock forming a bottom at 4,200 mark. So look at targets of 43.40, stop loss at 41.60. And the second is about Bombay Dyeing. That's a chart which is looking very attractive at 230 plus mark where it's trading. Buy with a target of 248, stop loss at 223.
Kunal, thematically though, whenever the market recovers today, tomorrow, next week, or whenever it is, what's going to be the first recovery sector? Is it going to be steel or other metals because that's where you're seeing a meaningful move, and more importantly, sentiment led?
See, in the last 5 attempts of the markets going to this 5% correction, every single time we've seen new sectors emerging. So in fact, in the previous last 2 attempts, for example, two attempts back, the index saw major change where we saw the PSU stocks which are outperforming. They went to a huge underperforming spree. There was a sharp profit booking, selling into these stocks. What rose up, were the likes of IT, autos, as well as the pharma, IT, FMCG, and pharma spaces. In the recent month, in the month of September, when the markets went to such kind of a correction, we saw the emergence of metal stocks and the banking index, which made a comeback. Now, so far, it looks like that the metal index is the one of the strongest one. But only over the next 1 or 2 weeks, once the selling settles down, is where clarity emerges in terms of which is the next sector to look out for. So I think I would not be preempting the move over here, but over the next 1 week, if there is any kind of a strength in terms of relative momentum building upon those sectors, I think one should try and position over there.
Okay, let me hand it over to Ashesha then to wind up how this Thursday has been. But Kunal, Naresh, Mayuresh, all of you, thank you so much for your time.
Complete carnage on Dalal Street. Clearly, Nifty ending nearly 550 points lower. 25,250 is where Nifty is ending today. Bank Nifty, let's also talk about that. About 1,100 points gone over there. Nifty Bank ending at about 51,875, and it was all across the board. Broader markets were also under pressure. Nifty Mid-Cap Index lost about 1,350 odd points. All sectoral indices are ending in the red today. About 10.6 lakh crore of market cap erosion is what we saw on Dalal Street. So yes, a difficult trading session that has come in. Let's also talk about individual sectors and stocks then. Reliance Industries, big boy. The stock was down nearly 4%. It hit its 3-month low today. So yes, Reliance Industries 4% lower. 20812 is where we are ending. Nifty Realty Index, the biggest sectoral loser in today's trading session, down about 3.5%. We had Phoenix Mills down 5.5% today. Godrej Properties and DLF were some of the other losers on the Realty Index, both of them ending with losses of over 5%. Auto stocks were also under pressure. We had some auto sales data that came in on Tuesday. Nifty Auto Index down 3%. We had APL Apollo, which was down 4.5%. Tata Motors down 4%. Maruti was also down nearly 4%. So across the board, across sectors, we saw only one color, and that was red. Let's also talk about Dabur. It came out with its Q2 operational updates, and that was on the weaker side. Management expects revenues to fall. Margins are also expected to be under pressure. 6% gone over there. All of these oil marketing companies were also in focus. We had HPCL, BPCL, IOCL, all of them declining anywhere between 3 to 7% in today's trading session. Let's talk about some of the gainers in an otherwise weak market. Angel One, on account of an Investec note that came in where they've gone ahead and upgraded the target price to 3,000. This was up 4.5%. Alembic Pharma, on the back of a US FDA approval, was also gaining nearly 4 to 4.5%. Two companies on the back of order wins. ITD Cementation, where the company won orders worth about 1940 crores. This stock was soaring, locked an upper circuit of 20%. And we also had Ashoka Buildcon up 2.5% on the back of order wins yet again, 1740 crores, 3 order wins, the stock ending 2.5% higher. Let's talk about Titagar Rail, some resizing of the order. This stock was down 3.5%. We had KPIT Tech, which was also gaining nearly 1.5% on the back of that brokerage report. But all in all, very weak session on Indian markets. Nifty ending at about 25,250.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.